From the morning reading, there's quite a few interesting little nuggets this morning. CNX and rails lead transports higher. The Dow ends back over the 50-day average. The NASDAQ 100 nears test of high and leads market higher. Broadcom leads technology and semiconductor ETFs higher. The S&P 500 is again testing the top of the symmetrical triangle. And Bank Spider nears upside breakout. Chinese stocks resume uptrend. With the transportation rising today to the highest level in a month, you'll have the Dow Industrials gain about 100 points. The blue chip index is once again approaching the upper end of its recent consolidation pattern. The first barrier it needs to overcome is last week's intraday high at 18,169. The NASDAQ 100 nears its first quarter high, with the technology spider XLK reaching its highest level in a month. The S&P 500 tests the top of the triangle. This time last week, the S&P 500 was testing the upper resistance line in a symmetrical triangle. Friday's downturn prevented an upside breakout. We're right back up against that resistance line once again. And despite a generally rising market, assets invested in long-only S&P 500 exchange-traded funds have dwindled relative to assets invested in short-only funds. We saw this in 2013 and 2014 before stocks rose in earnest. The ARMS index was extremely low on Wednesday, in the bottom 7% of all readings since 1962. It was caused by much more volume flowing into stocks that were up on the day than volume went into declining stocks. On days with such a low ARMS index, the S&P 500 rallied an average of 1.4%, compared to barely 0.5% on Wednesday. Such weak rallies has happened only 15% of the time. It tended to be positive for stocks. A week later, the S&P was higher 69% of the time, 100 out of 145 events, averaging 0.5%. If the S&P was within 1% of the 52-week high at the time, it improved to a win rate of 83%, 35 events out of 42 days, averaging 0.6%. Results moderate over time, but they're still at least modestly better than random. Good morning. This is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:10 a.m. Central Time, and I'm recording this in preparation for the market day, April the 23rd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's find out what was happening in the overnight action. Well, in general, broad market weakness, especially with the Russell. Russell is down about 0.79%. The S&P down about 0.2, as is the NASDAQ. YM just a little bit more, about 0.3. Crude oil down about 0.5%. Euro up about 1/3%. Bonds sitting on scratch, as is gold. In terms of overseas action, China up about 1/3%. Hong Kong going the other way by also 1/3%. Japan up about 1/4%. Germany has some weakness, down about 0.7%, and the United Kingdom up about 2.4%. So in the U.S., mostly broad market weakness, but in the overseas action, it is pretty mixed. In terms of macroeconomic reports for today, the usual Thursday suspects: unemployment claims. We also have flash manufacturing PMI and new home sales, followed by natural gas for those of you in that market. Tomorrow, core durable goods orders is about it on the U.S. market. You can take a look at the other markets if you are seriously involved with those. In terms of volatility, nothing really too exciting yesterday. You see the short-term VIX is down below a 12 once again. We really are starting to push those lower levels. Now, certainly regular VIX, when it gets down into the 12s, we think of that as being pretty low. And yet, there are, if you look back on the charts, there are prolonged periods of time where we go to 11 or even start tickling the 10 handle. So just be aware that we are both concerned. We take it as a warning sign when the VIX gets low that volatility could increase. The problem is we don't know when, and we have to look for other signals to help us determine that. So you see also historical IV percentiles, all again very low. No standard deviation moves yesterday in the 4 broad market indices. So after a period of time where we went about 3 weeks where every single day it seemed like we were having a standard deviation move, we followed that by about 2 weeks with nothing going on. And then we had a little cluster of a couple days, big down day, followed by the chains and Chinese margin requirements, and then that was then followed by a big up day. Other than that little burst of volatility that came in now 4 and 3 trading days ago, we've really had very quiet action for going over 2.5 weeks now. In terms of our regular daily report, gold futures, let's take a look at the volume there. That must be getting terribly close to rolling over. Give me just a second here. Look at that volume. Let's see. It would seem that no, not ready yet. I was thinking we might be rolling over by now, but no, volume's still all in the old, so no worries there. In terms of everybody, market trend intermediate term phase opinion phase 3 still remains the order of the day. We are desperately looking for this confirmed higher high, and still do not have that in the S&P yet. We do have those warning signals still in place in the portfolio investor posture. The IBD status still remains uptrend under pressure. GMI index, though, is at a 6 out of 6. Active trader market posture is solidly bullish. We do have our differing opinions on position sizing coming in. Investor position sizing calling for 50%. And really that is reflected by the number of warning signs that we have coming in. Volatility for the active trader position sizing would call for up to 100%. Market timing is gone neutral for both 1 and 3 day, as well as neutral for the 2 week period. So not a lot of edge to enter new bullish positions at this place, even with this market posture. So consider that, and consider perhaps if you're going to take a new position. I mean, it is okay to take new short-term and intermediate-term bullish trades based on the market posture indicator, but at least consider the potential of scaling into those positions instead of taking your entire position and putting it all on at the same time. You obviously also had this portfolio side exposure calling for 50%, so it's just not a lot of edge to be an all-in kind of approach right now. You also do see a couple warning signs across the Dow, as well as the Russell. Actually, the Russell went from being very bullish to now bearish on its market posture, so kind of consider that as well. Threshold Level 1 is our current hedge warning status. That's been that way for quite a number of days now, and a number of reasons for that. Obviously, the daily squeeze is still present, and we're now at 16 days and counting. Distribution days, NASDAQ 6, S&P 5. So while this has moderated some in the last couple of weeks, it's still high at 5 or greater. Intermarket indicators, really They look better in that 3 of them have now flagged as risk on, and the other 2 perhaps are crossing over, and yet at the same time they're very much wrapped around each other. And if you actually looked at these charts, you would see that this is probably best called neutral. Option income strategies, VIX is inside the acceptable window, but in a daily squeeze. Do consider we're starting to get towards the lower threshold of that acceptable window, to where frankly the amount of premium available is so low compared to the level of risk that you are taking that it becomes problematic to initiate option income strategies. So if you see that VIX drop below a 12, that would be a warning sign. Cover call strategies, very much in line with what we were just talking about above. Very neutral. Be conservative. If you're going to initiate a new position, consider scaling in. Also consider a 2-to-1 distribution between the in the money and out of the money strikes. Put selling, pretty high to be putting on a put sell opportunity unless you get some sort of earnings miss and that presents an opportunity. And indeed, I know, like yesterday in DD was a beautiful example of that. Good large cap stock that had an earnings miss, spiked down, presented an opportunity to sell puts. Frankly, I took off the position before the end of the day. I'd achieved about 2/3 of my profit target, within one trading day. And when that happens, I generally take my profits that same day. So very interesting example there with DD. Spikes down and yet finishes the day up more than 1 standard deviation. That's a quick profit target to always kind of take into mind. So there are opportunities presenting themselves even in a kind of neutral market posture where you have individual companies that might present an interesting chart. You have also our sector specific market posture. Obviously yesterday was fairly bullish, and a lot of green on our short, intermediate, and long-term postures, market postures for these specific sectors. Note probably the ones that are the weakest, retail and utilities in particular. And the percent change yesterday, information technology up over 1% with the best performance of the day. Financials followed, and telecommunications. Consumer staples, consumer discretionary, healthcare, some of those lower beta areas, especially utilities, also came in relatively modest yesterday, so that is of some note. Industry specific, not a lot of change here. Retail, internet, healthcare, railroads, biotech are at the top of the shadow trader industry rankings. Now retail certainly has taken something of a hit of late, so might want to dig down and look at the individual pieces of that. Same thing with biotech. Biotech is something of a difficult ride, and there are many other industry groups that I would point to that are giving returns that are beating the S&P and yet more consistent, less volatile in getting there. Now, if you're a really nimble trader, then there's clearly opportunities in the volatility of biotech, and that also can be said of pharmaceuticals. But it's also something to be said that there are some other industry groups that might be able to give you those returns or better without some of that volatility if you want something that's a little tamer in your portfolio. Well, that should take care of us for today. As always, we greatly appreciate your reinvestment into us by favoriting us, liking us on YouTube and the other social media platforms. Additional information, if you'd like, is available at the website, and that would be falconglobaltraders.com. And of course, as always, you can email us with your comments or suggestions. Disclaimers: hit the pause button if you need more time to review this. And then finally, we'll look forward to seeing you back here in our market preview tomorrow morning. Good trading.